So Kimeme, you can now send to the others. Otherwise, I'm looking at the theory bit of this, so I could very comfortably be reading, right? So, ladies and gentlemen, one thing that you're supposed to be knowing from the word budgetary control techniques is this. Budgetary control techniques. Budgetary control techniques. Budgetary control techniques. That first of all, a budget is a financial plan. Very, very important for you to know that a budget is a financial plan. Yeah. That covers a defined what year? A defined period. That covers a defined period. Yeah, future period, of course, isn't it? So a budget is a financial plan. We'll have a plan of our revenues. How do we raise our revenues? How do we spend this money? How do we spend this money? Yeah, what are the various AIE, what we call authority to incur expenditure holders? So a budget is a financial plan that covers a defined period. But you see now in your syllabus, they want us to cover what they are calling what here budgetary controls. Budgetary controls. So under budgetary controls, what I'm supposed to remember, ladies and gentlemen, is that a budgetary control normally compares budget and actual amounts in order to ascertain variances, in order to ascertain variances, in order to ascertain variances for control purposes, for control purposes, for control purposes. Yeah, budgetary controls. Whenever we say that you're doing budgetary controls, we are looking at a situation where you are comparing, these are your items, X, Y, yeah, W, Z. So we have a budget here, and then we have actual there. So a budget is 10, and maybe actual is 12. So we had budgeted, ladies and gentlemen, in this case here to spend 10 bob. But we've actually spent how much here, somebody? So do we have a variance? Yes, we do. We do. So if this is an expense, we have a variance there that we shall be calling what here? Adverse. We have a variance here which we shall be calling adverse. We have a variance here that we shall be calling adverse, like that. Yeah. If, for example, we had budgeted to spend 100, but you've spent 90, I can see the difference between the two is 10. But if this is an expenditure, it means we have saved. We have saved because budget is our plan. We had planned to spend 100, but we have actually spent how much here, somebody? 90. Meaning that we have saved how much here, somebody? 10. So meaning that this particular savings, we shall call it favorable. Remember, A stands for adverse. A stands for adverse, and F stands for what here, somebody? Favorable. And F stands for favorable. F stands for favorable, like that. So whenever you are calculating this kind of variances, then you are trying to be in control of things, because you are able to know in advance that, hey, ladies and gentlemen, I have planned to spend 100 bags of cement. And then when the work is going on, I'm monitoring the work that is being done. So if the actual, for example, 100 bags, if the actual is 120 bags, I'm able to call people into their positions of responsibility, because you tell this person, why do we have to spend this extra 20? By discussing like that, you're going to, all of you, be very, very serious. Yeah, you're going to be having all your eyes on the budget. so that you can be able to make savings. So you'll be able to say that your staff is under control. So then let's now read these aspects very, very fast. Let's read these aspects very, very fast. So budgetary control is the process of comparing actual performance with budgeted performance, analyzing variances, and taking what are corrective actions It serves as both a planning and a control tool, ensuring efficient resource allocation and achievement of organizational objectives. How do we apply these budgetary control systems? We normally apply these budgetary control systems, number one, to come up with various types of budgets. And the first one is what we are calling the top-down budget. What is a top-down budget, ladies and gentlemen? A top-down budget is that particular type of a budget that is prepared by the management up there. It is prepared by the management up there and then brought down to employees, in this case here now, who have to implement. Brought down to employees who have to implement. Brought down to employees now who have to implement. So whenever we talk of top done by the management up there, given to employees for purpose to implement, of course, this will be very demotivating. So top-down budgets are set by senior management with minimal lower level input. It's fast to make because, there is a lot of hustling here and there. So fast and strategically aligned, but may lack operational realism because most managers don't understand what happens in the business. Those lower cadre of employees are the ones who know this business better, and you don't want to involve them. Then we have bottom-up budgeting. Now this is from down up. So bottom-up, normally what does that mean? We have now employees being involved. We have departmental managers who will be able to come up with this budget, and then it goes up for endorsement. So budgeting, lower level managers prepare budgets, which are then consolidated upward. Improves accuracy and motivation, but can cause what we call budgetary slack. How do these budgetary slacks in this case here come by? Remember, a slack is excess. A slack means what here excess. Yeah, because in this case here you are using employees. These employees would always want to look good performance-wise. So if they know that an activity is supposed to be taking, say, 100 bags of cement, for them, what they will do, they will pad the budget. So padding the budget, which will lead to a budgetary slack, they'll make this 100 here to be a very, they can't work with 100. So in this case, they're going to plan to use how many? 120. And then now if the actual budget is, not actual budget, but if actually they use 90, so you're going to see that they are getting very abnormal favorable variances. When you involve these employees, remember generally that some employees go to their workplaces every morning with an intention of not working. Some of them even with an intention of stealing. So if they would want to flex these budgets in a way that are going to favor them, they can easily end up having budgets with excess slacks, especially when they know that you are mostly using these budgets to evaluate what year Yeah, Mwalimu, that is me. In terms of budget, there is a lady here who knows how to create budgetary slacks. That is bottom up. Then we have a rolling budget. In an exam, if somebody was to ask you what is a rolling budget, and you happen not to be knowing, but you'd want to write something. So will you say it's a budget that rolls and rolls and rolls and rolls? What will you say is a rolling budget? A rolling budget is a dynamic budget. It's a budget that keeps on doing what somebody changing. So a rolling budget, these are continuously updated budgets, maintaining a constant 12-month horizon. They reflect current conditions, but adds administration work. Please listen and listen to me very well. So for example, currently, we have companies that have done a budget up to 2020 what year? budgets for 2026. So 2026, what do we have? They have a whole, 2, 3, 4, 5, 6, 7, 8, whatever. So we have January, March, May, July. We have in this case here September, November, December like that. So you see, currently we are in the month of November 2025. So if it's a rolling budget that we have, we shall still just continue with our normal operations up to the beginning of January 2026. And then now we start now rolling over the budget. We start in this case here, working with this 2026 budget. Now listen, for this to become a rolling budget, it must always be 12 months ahead of us, always. So then what would that mean? That the moment in this case here, we exhaust the month of January 2026, we shall be able to extend this budget to the next year and cover now January 2020, what year? 7. So we keep on rolling like that. We continue, we utilize February. And then we open a new month there for February 2027. Then that will be a rolling budget. It is continuously updated to contain newer periods, A rolling budget. So the most important thing on a rolling budget is that concept of continuously updating this budget with newer periods. And because of that, then our budget will be always in current terms. All right. So rolling budgets, they are continuously updated, e.g. quarterly, maintaining a constant 12-month horizon, reflects current conditions, but adds admin work. Then we have what we call zero-based budget. Have you ever heard of zero-based budgets, my good students? Or do you know what zero-based budgets are? The students who are online, what are zero-based budgets? What are zero-based budgets? They're not talking to me whatsoever. Somebody should be able to share this handout with Dennis. From the word zero, you're starting from scratch. You start from nil in making your budget, in making your ZBB. So a ZBB, a zero-based budget, is any budget whose preparation normally starts from zero base, nil. We don't make reference to any previous period budgets. We don't make reference. So zero base. You see, like in Africa, we are quite lazy. I hope you guys, because you're young, you'll be able to change that narrative, isn't it? Because if you look at most African, ladies and gentlemen, in this case here, governments and the big companies, they always use what we call incremental budgeting. So under incremental budgeting, they use last year's budget as the base. And then they say multiply everything by 110%, or whichever percent they agree. So they come up with an increased budget. That is why the other day you were seeing Kenya's budget being $1 trillion. It went to 2 trillion. Now we're at 3 trillion because you're using an increasing what year? Budgetary, incremental budgetary system, not zero-based. So under zero-based budgeting, as you start everything from scratch, we can only allow you to have your item being on the budget if you are able to justify. And you can only justify that you need this money in your budget if the cost is less than what you're somebody the benefit. You must do best cost benefit analysis. So all the expenses have to be justified. You must justify them. We call that one zero-based budgeting system. All secondary schools, we are told in this case here they use incremental. Harvey, please try to use this zero-based. So then we have activity-based costing or activity-based budgeting. It focuses on budgeting based on cost drivers of activities, improves cost accuracy, but requires detailed what here? Detailed data. Incremental budgeting builds on previous year's budget with very small what here adjustments. Simple but may perpetuate inefficiency. We have feedback and a feed forward. What here? Controls. Feedback compares actual versus budget after the event and prompts corrective action. That's feedback. So you wait until the actual is over and then you make comparison. You look back and say, hey, these are the variances, and in the future, we expect to minimize the adverse ones like this. Then we have the feed forward. Feed forward is able to predict the deviation. Now here you look at the deviations in advance. So feed forward predicts deviations before they occur, allowing preventive what here? Measures. So under feed forward, we are able to look forward and say, hey, if we continue with this kind of expenditure, if we continue with this kind of spending, then we're going to spend more. We don't have to wait to spend more for us to start talking about corrective actions. Why can't we change the trend today? So we are able to anticipate any variances, and then we apply corrective actions, thinking forward. We call that one here feed what here, somebody? Feed forward. So we have feedback. Feedback is more historical. Feedback, you wait until the actual is over at the end of the month. That is when you calculate your actual variances. And then, they are so big. But history is history. You can't do anything to history. Now you can use those big diverse variances to inform your future. 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 So use of operational variances in reconciling original budget with actual performance. So this one we shall be able to use the same question, which is on May 2015 actually, long ago question. I've already done it in the evening class. Let's see whether I'll be able to get it pretty fast. Sorry. August. Yeah, let's just do a new question. Let's do a new question. August 2022, question number 4, cow. 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 Once you get it, kindly mention there, yes. Are we there? Are we there? Yeah, the online guys, they're also telling me, Mwalimu, we are there. So AMA, they have got this thing of them repeating questions, word by word. Like now, this question was a May 2015 question, which I've already done with the evening students, but let's just repeat this. So even the figures, they never changed nothing. They only changed the question a little bit, just the questions there. So Ukunda Limited operates a standard marginal cost accounting system. Information relating to the product, 𝐁𝐥𝐤𝐤, which is made in one of the company's department, is given below. Additional information, variable production overheads vary with units produced. Number 2, budgeted fixed production overheads per month amount to 1 million. The budgeted production for product 𝐁𝐥𝐤𝐤 amounted 20,000 units per month. Actual production and cost for the month of June 2022 were as follows. You can see the number of units here of 𝐁𝐥𝐤𝐤 produced to how many? 18,500, isn't it? Then we have direct materials, direct labor, etc., many other good things there. Yeah. Then they want us to prepare in columnar format a statement showing original budget, just the costs only. Remember the one that we did of May 2015 had the original budget, the profit and loss. They wanted us to show revenue and cost. These one, they only want us to do cost. And then number 2, the flexed budget, again by element of who? Cost. Then number 3, the actual production statement by element of cost. And then we give them the reconciliation of the actual production cost with the budgeted production cost. So we start with the original budget by element of cost. Very easy. So let's give our examiner the original budget. Original budget. So original budget, we shall have here flexed budget, and we shall have here actual results, actual results, actual results, actual results, actual results. So they only want us to do cost statements only, not P&L. They only want us to do cost statements. Let me read. I can see somebody trying to chat with me. I always endeavor to answer all questions. They're only saying yes, right. They're only saying yes, right. So what is the name of the first expenditure? Nowadays, you don't talk to me a lot. No, the first cost expenditure, it's direct material. If you look at, yeah, it's direct materials. Yeah, you can see, this original budget will come from the standard. And the standard cost card, the first item there is called direct what here, somebody? Materials. So right there, direct materials. So direct materials, I can see each unit will take me how much? Each unit, please talk to me when the online students. Each unit will take me how much? Is it 40 per kilogram or 240? 40 or 240? 240. Because I want cost per unit, and then I multiply this with the number of units. Because you see, 40 is per kilogram. I'm not measuring my output in kilograms. So it is 240 per whole unit, because you can see here, standard marginal cost per U on that column. So it is 240 per unit. Remember, they want budget, So then I should multiply that 240 with the budgeted output. Is there anybody who is able to see budgeted output? Anybody who is able to see budgeted output? Why they are not talking to me? 20,000 in note number 3, isn't it? Note number 3, 20,000. Thank you so much. So times 20,000. So then are you able to give me this answer? Are you able to give me this answer? If you don't give me an answer, I'm going to punish you. I'm going to punish you. I'm going to punish you. 4.8 million. Thank you so much. 4.8 million. And then you see, ladies and gentlemen, of course, I can't punish you guys are big people. I'm not teaching kindergarten. The only punishment that I can give to you, which is, of course, within your ability, is to tell you that I'm going to have lunch at the Sarova Stanley and then ask you to pay the bill because you are capable, isn't it? That is a very good punishment, but I don't want to go that way. All right. So you see, we cannot go to flexed budget. First of all, you have to finish everything here. So after direct materials, the next expenditure is known as direct labor. So direct labor. So for direct labor, are you able to see, ladies and gentlemen, how much do we incur for direct labor per unit? 70 per unit. So times the budgeted output of 20,000. So then that will end up giving me 1 point what here, somebody? That will end up giving me 1.2, 1.4 million, isn't it? Am I recording this class? Oh, yeah, I'm recording. Yeah, thank you so much. So 1.4 million. Thank you so much. After direct labor, what is the next name of the variable production overhead? The variable overheads. How much per unit? 30, eh? Per unit, not per hour. So 30 per unit. So times what here, somebody? 20,000, isn't it? Times 20,000, which will end up giving me what figure? 600,000. 600,000. So remember, I want to do the total cost. So I must bring in the fixed overheads, which I expect you guys to give me an answer. How much is the fixed overheads, Rina? One of my very best students, just like Bahati and many of you here, even Airo Jane, even Edwin, they always give me figures. Budgeted overhead, not number. Not number 2, they've given us budgeted overheads of 1 million, isn't it? And that is it. So please go ahead and add for us to give us the total production cost. Total budgeted production cost. $78. My brother is getting 6. I know why. Don't even, I know why. He doesn't have a calculator. 7.7800, eh? Thank you so much. Then I underline. So then can somebody tell me, what do you think shall I do to be able to get this flexed budget? We get the flexing ratio. Had we done this with you? Okay. Then why am I repeating? Had you done this same question? So I can finish it, eh? All right. Thank you so much. Then get ahead and give us what we call the flexing ratio. The flexing ratio. To get flexed budget, we need the flexing ratio. So this flexing ratio is very easy to get. You normally take the actual output divided by what here, somebody? Budgeted output, yes. Divided by budgeted output. Don't write inside here. You know me, I'll do a abracadabra, I'll rub this. Yours case. Otherwise, you'll see international disaster. Yeah. So in this question, do we have our actual output given? And tell me which note number. Note number? 18.5, eh? 18 number 4, we are able to see the actual output is 18,500. Divide this by the budgeted output. Divide this by the budgeted output, which will be equal to... I can see somebody online who is really scratching their head. See the budgeted output. Don't scratch your head. It's 20,000, isn't it? Yeah. So then this gives us 0. What here, somebody? 925. So remember that this flexing ratio, we normally apply it to dynamic items. Items that change as the number of units here change, dynamic. We shall never apply it on constant or fixed items. We shall never use it. So anything dynamic, like direct material, what do you think of direct materials? That is dynamic. Keeps on increasing as the output increases. So this one, for me to get this flexed out budget, I will take this times this one here, times 0.925. Direct labor the same, times 0.925. Variable overhead the same times 0.925. Fixed overheads, we shall not flex them. If I get you flexing the fixed overheads, that will be disastrous. We only flex items that change. Things like sales revenue is a dynamic item. Because sales revenue, if it was here, I mean, the more we produce, the more we sell, the more the revenue. So it's only dynamic items. And everything is normally dynamic apart from whatever they call fixed. So then can somebody give me this answer? 4.8 million times 0.925, give me an answer. 40,000. Online guys, are they able to see this 40,000? Online guys, you're a little bit quiet. You're a little bit quiet. Thank you so much, Rina. Thank you so much, that gentleman there. How about direct labor? We have 1.4 million times 0.925. 12.95. 12.95. And then we have variable overheads. They are dynamic. 600,000 times 0.95, which will give me hydrogen 555, isn't it? So 555,000. And then fixed overheads, if the devil comes your way, you'll flex it. And we don't want the devil anywhere near us. So this one, we take it as what here, somebody? 1 million, isn't it? Because we shall not flex that one. Now, from there, ladies and gentlemen, we want actual results. The actual results, so the actual cost statement, that one is always given to us. It's just a way of this examiner giving us what I normally call free manna from heaven. Just copy and you get marks, and then you go to the next serious paper. Because management accounting is never serious. It's never serious. Management accounting is never serious. It is the simplest of all the papers. So you can see direct materials. Are you able to see 44,26,500? 44,26, what year 500? 44,26,500. So long as you don't mix those things. Direct labor, I can see it is 12,99,400. 12,99,400. Then we have variable overheads. What do we have for variable overheads? 588,000. So here we have 588,000. Then we have fixed overheads, which is 1040,000. And I forgot. I want you to be giving me these totals, eh? You must give me these totals. The actual total I know. The actual total I know it's 73.53. 73.53. 900. The only total I don't know is the flexed budget. How do you add? There is something I need to learn from this lady. 70? 290. I would want to know your secret. How do you punch this calculator? I would want to know your secret. I would also want to be a superstar, right? Well, at my age, there is nothing new I can learn. I'll learn. Trust you me. I will learn. Now, please listen. I've always seen people going wrong, getting it zero here. If the examiner tells you to reconcile flexed budget with what here, somebody? Actual results, then you'll come and do a column for variances here. You do a column for variances there. If the examiner tells you to flex this, or rather, to reconcile flexed and actual, you create a column for variances there. I've always seen students getting it wrong there, totally. So variances, you subtract 40,000 minus 26,000. And a very good student, okay, first of all, let me get an answer from you. I'm being told, ladies and gentlemen, the variance here, 72, 13,500, 13,500,000, or just 13,500, 13,500. Okay, is that a good variance or a bad variance? It's a good variance. Why have we saved on cost? Are you sure you've saved? How have you checked this out? We have used less materials, eh? We have used less materials, you are right. Thank you. You have saved, isn't it? So then it's favorable, right? It is favorable. It is favorable. 13,500. 13,500. Favorable. Always remember, I don't have to think about whether I've used less materials or less or more. What I'm supposed to know is that whenever I'm getting variances for expenses, I normally use ba for ba. So ba means what? Your budget minus actual. Budget minus actual. Budget minus actual. Like now the second one, you see this is the budget now, and this is the actual. So like now the second one will be 1295,000 minus 1299,400. 500 for 400. So is it positive or negative? So then if it's negative, I know if I'm using this concept of BER, all negative variances are bad, adverse. If I'm using this concept of BER, I don't have to keep on reasoning. So if I'm using this concept of BER, that is a budget minus what, somebody? If I get negative, I don't write negative. It what, somebody? I write adverse there. Then we go, ladies and gentlemen, to the third one actually. The third one actually, thanks, Jane. The third one actually. So in the third one, what do I have there, my good students? Negative, 33,000. And because it's negative, that is going to eat onto our profits. So it's adverse. It's adverse. And then the last one, this one I'll be able to get without asking you. I'm also now a very bright person. Then in this case here, what here? Adverse. Can you kindly give me the total variance? Take this minus this. Bar. 7,290,000 minus 73,53,900. What are we able? 63,900. Adverse or favorable? Adverse. Please check whether these ones, if you combine them, how do you combine them? This is 13,500 positive minus 4,400 minus because that's adverse minus because that is 40,000. Where is your calculator? Or you have already done it? Oh, even your speed is that high. Then I'm the only one in this case here. Is it adding up to 63,900 adverse? Very good. Very good. So now I can take a red pen and exam and then I mark for myself. It's never allowed, isn't it? It's never allowed. It's never allowed. Don't use a red pen. All right, ladies and gentlemen. That is when they ask us for a reconciliation between what and what? Is it budget or flexed? Flexed and actual. But if they ask for a reconciliation between original and what, somebody? Actual, then you have to do that full variance analysis. MPV, MUV, labor rate variance, labor FE. When they ask you to reconcile between original and what, somebody? Actual, we have to go the full variances. So let's read the question. Let's read the question. We get to see what this examiner wants us to calculate. So this question, when I see Roman 1 is already done. Now we look at Roman 2 flexed budget, that is already done. Roman 3 is already done. Roman 4, a reconciliation of the actual production cost with what, somebody? Budgeted production cost. So of course that will be the original budget. They are silent about which budget. Whenever they are silent like that, we shall always work with the original. Shall always work with original. So, and if it's original, ladies and gentlemen, what am I going to do in this question? We're going to calculate how many types of variances? 4. Remember, we have 5 types of variances, generally. When we include, say, sales. But you see now they don't want us to do all the 5. They only want us to work with the cost variances. And the cost variances are 4. For material cost, labor cost, variable overhead cost, and fixed what here over overhead. Now that I'll be able to do pretty fast. We start with the material variances. I don't have to write like that. What I do, I know material price, material variances, we have material price and the material usage. Let's start with the material price variance. Material price variance. So you write there, material price variance. So we have here material price variance. So material price variance, what do we have? Are you able to remember the formula? Difference between two prices. Because it's price variation. We have the price that we thought would have used to buy these materials. That's standard price. So we have here the standard price minus the actual price. That will be variance per kilogram, multiplied outside here by actual quantity of materials that were what here purchased. And remember that these are standard prices per kilogram or standard price per liter. So like now in this case here, our materials are being measured in terms of what here? Kilograms. So is there somebody who is able to see the standard price per kilogram? Where I'm alone, but I will overcome, especially the online students. They're not talking to me at all. It's 40 per, it's here. It's 40 per kilogram, isn't it? It's 40 per kilogram. So I'll write here 40. Then I say into brackets minus actual price. So the actual price I can see from the actual results. Note number 4. Actual results, actual production and cost. You can see material total cost was 44.26. 44.26. 500, isn't it? But you see that is total divided by the kgs that were bought. And the kgs bought were 113,500. And then I say times the actual quantity, not actual quantity produced and sold, but actual quantity of raw material. And from the actual results, we are able to see that the actual quantity of raw materials was 113 what here, somebody? 113,500, isn't it? 113,500. Wait, I don't know whether we are together. I don't know whether we are together. So into brackets 40 minus 44, 26,500 divided by 113,500 times 113,500. You don't have to do this separately. No, you simply say open brackets 40 minus this divided by this, you close, times 113,500, which then at the end of the day will end up giving us what answer? Is there somebody who is able to see the 113,500? And if it's positive, what do? We say that this variance is favorable. We say this variance is favorable. So remember, you take your brackets, so you have a clear time, you say open bracket, 40 minus 44.26,500 divided by 113,500. You close, isn't it? Times 113,500. You'll be able to get that answer 113,500, which is positive, which basically tells me that everything there is good, favorable. Is that okay? Now from there, ladies and gentlemen, we shall be able to go straight away to material usage variance, isn't it? So material usage variance, this is a quantity variance. Quantity variance. Difference between two quantities. The quantity we anticipated to use, what we are calling SQ. So then this one here will be SQ minus AQ. Standard quantity minus actual quantity, and then you monetize. So anytime you want to monetize outside, we normally use the standard price per kilogram. Anytime they want us to monetize, we shall always use the standard price per kilogram. Please don't forget that this is standard quantity for actual production. Standard quantity for actual production. Standard quantity for actual production. So go to your standard cost card and read the standard quantity given there. Go to your standard cost card. So my standard cost card, my standard cost card. So my standard cost card up there, ladies and gentlemen, my standard cost card up here, I've got direct materials. How many do I need? 6 kilograms. But you see, that is for 1 unit. So then I will be able to come and say this equals 6 times the actual number of units that were produced, because it is standard quantity for actual production. And we produced how many? 18,500. Please, sorry for this. Write this one here for me. That this stands for AQ used. For you to not to forget and think it is 18,500 again. This is the actual quantity of raw materials that were used. So do we know how many kgs we used? Do we know how many kgs we used? Abracadabra. Do we know how many kgs we used? Abracadabra. 113? 113,500 kgs, yes. And do we know the standard price per kilogram? Up there per kilogram, remember how much? 40, yeah, not per unit, but per kilogram. Please, everywhere you would have written this in full somewhere, that capital SP stands for standard price per kilogram. Thank you so much, Bahati. Thank you so much, Bahati. So the moment you are able to understand that this capital SQ is standard quantity for actual production, capital SQ is a pregnant SQ, standard quantity for actual production. You can never go wrong. Never. You can never go wrong. You can never go wrong. So then the final answer is supposed to give us something. And if it's positive, then the variance will be favorable. If it's negative, the variance becomes what here? Adverse. So somebody tells me it is 100,000. It is 100,000 what they are? Adverse. It is 100,000 adverse. It's 100,000 adverse. So I can see these day classes are also becoming very popular for the evening students. So the next day class is supposed to be tomorrow. It's supposed to be Thursday at what time? 11. And then Friday at 9. Please purpose, because I can see they are becoming very, very popular with you guys. All right. So after you finish material usage variance, now I can comfortably go to labor, isn't it? So you can call that one the third variance. We can call this one the third variance. So third variance, the third variance is labor rate variance. Labor rate variance. Please write this in full. It's labor rate variance. I normally look at this from the context of university lecturers. Yeah, universities went to this year knowing that they were to pay lecturers maybe 3,000 per hour. But these fellows decided to strike. So when they strike, what does it mean? Us increasing the rate for them. Because if we cast all our eyes on stone and say we are not changing anything, then the students will suffer as the government. We have to increase. Then we take the rate to 5,000. So you can see there are two rates there. There is standard what we are planned. There is actual. So in this case here, we have standard rate minus actual rate. Remember, this is standard rate per hour. Right like that somewhere there. Multiplied by actual hours paid. So remember, standard rate per hour, standard rate per hour, standard rate per hour. And then we have actual rate per hour. Throw your eyes to the standard cost curve. Are you able to see the standard rate per hour? Per hour, it is 70 bob, isn't it? So if we throw our eyes, thank you, Magdalene Langat. If we throw our eyes to the labor per hour, we can see the 7 minus the actual rate. There is ninjas who would want to get this actual rate separately. No, don't do that, because you'll mess up in terms of decimals. Go to the actual for the actual rate, go to the actual table and pick the labor. I can see the labor I in the card 1299,400. I in the card 1299,400. Divide these by the total actual hours. And the total actual hours, you are how many? Yeah, 17,800. Then outside here, we shall come and put actual hours that were paid for. Actual hours we procured. So the actual hours we procured were 17,800. So the online students, are you able to hear the background of our music? So I would want to get some feedback. Are you able to hear from my microphone? Are you able to hear some? Oh no. Then this thing is able to cancel. how I wish I had a way of ensuring that it comes through a little bit. It's very good music. It's very good music, but yeah, let's leave it out. So open brackets, 70 minus this divided by this, you close times 17,800, 53, 3, 4, adverse. Thank you so much. Now, from there, ladies and gentlemen, we have number 4, what we call labor efficiency variance. So anytime we hear about efficiency, always remember that in Kenya, there is only one community that is efficient. All the other communities, be it Kikuyu, Somalis, Kisis, we are fake in business. The only community which is very, very serious with business is what we call the SHA community. Do you know them? Because they are able to build businesses that they leave to even their great-grandchildren. All the others, I know you are good. But you see, our business will only last during our lifetime. At the very best, you give them to your children, whom for the first 3, 4, 5 years, they start fighting over those assets. Within no time, Jenga Karume's way, nothing really. But the Indians, they are very good. So anytime you see efficiency variance, it doesn't matter which efficiency, it must be having Mr. Shah. Mr. Shah. It's a formula. You thought I was just giving stories, eh? We shall overcome. Oh, we Shah. Now you're able to see Shah, isn't it? Times the standard rate per hour. Times standard rate per hour. Times standard rate per hour. Yeah. Yeah. So remember, this capital SAH stands for standard hours for actual production. Don't forget this. Standard hours for actual production. Standard hours for actual production. So please, let's get ahead and do what here, somebody? Get the figures here. So is there somebody who is able to see the standard hours in the standard card? In the standard card, how many hours do we need? Only 1 hour. In the standard card, we only need 1 hour to produce, isn't it? But now remember, this is supposed to be standard hours for actual number of units that we produced. And you are the gentlemen and ladies who told me that we produced 18. We produced 18,500. Are we together? Thanks, Bahati. Thank you so much. How about AH? AH stands for actual hours. So actual hours were how many? 17. 17,800. Do you still remember that this is standard rate per hour? Standard rate per hour, which is what here? 17. $49? Favorable, eh? 49,000 favorable, isn't it? 49,000 favorable. 49,000 favorable. Is that okay? Now, so we are on to variance number 5. So remember, variance number 5 now will be touching on the variable overheads. I love variable overheads, especially there is one called variable overhead expenditure variance. I love it. And I'll tell you why I love it. Variable overhead expenditure variance. So variable overhead expenditure variance, this one we take the standard variable overheads per hour times actual hours minus that fruit that I love with my whole heart. That fruit that I love with my whole heart. If today you tell me you'll bring this fruit tomorrow, I'll be really thankful. It's called avocado. Minus avo. So long as it's a nice one. I know there are fake avocados nowadays. There are fake avocados nowadays, right? Yeah. Is there somebody who is able to get that very original one? They can even sell to me. They can even sell to me. So anytime they talk about variable overhead expenditure variance, we take standard variable overheads per what? Per hour. Standard variable overheads per hour times actual hours minus actual variable overheads. Minus actual variable overheads. What confuses so many ninjas is this. Standard variable overheads per hour. Normally you work with the labor hours. So go to the standard cost card. Are you able to see the variable overheads in the standard? 30? No. 30. 30. Is it 30? Yeah, you're right. We can see that the variable production overhead is what here, somebody? Is 30. But you see, this 30 is per unit. And I want it to be for each hour. So on the standard cost card, are you able to see how many hours do we need? Labor hours. Remember, they are labor hours. How many labors do we need? We are so lucky because what I know, all the students would have guessed and worked with 30. But they are so lucky because this 30 would be correct because you see, we only have 1 hour. What if there were 2 hours on the standard cost card? Yeah, you would have divided by 2. Because you see, we want to work with standard variable overhead per hour. Per hour. So you go to the standard cost card, you pick the standard variable overhead there, 30, and then in the same standard cost card, you look for the labor hours. Like in this case here, the standard cost card, labor hours, we have got how many? 1. So we are very lucky because I would have guessed 30 and gotten. Yeah, 30 divided by 1. Oh, I check on my mic. Oh, it has a problem, eh? Breaking a bit noise because some guys have brought something very noisy. Very noisy. Are you able to hear me now much better? I don't know. I don't know. That is really bad, very bad, but we cannot do anything much. Times, do we have the actual labor hours? Actual labor hours are how many? 17,800, isn't it? Minus avocado. Avocado is actual variable overheads. Go to the actual results. Go to the actual results. 588. Courier, you haven't yet seen that. Actual results, 588,000, right? If positive, favorable. 54,000, eh? Adverse, eh? Thank you so much. 54,000 adverse. So is that okay, ladies and gentlemen? So after variable overhead expenditure variance, I know the next variable overhead variance will be known as variable overhead efficiency. And you can't convince me otherwise. I know some of you could say that Indians are bad because they pay bad salaries. But having worked with them, these guys can teach you business. They are very, very efficient. Actually, it's only that they don't marry applicants easily. Otherwise, I would have given them a daughter or a sister, isn't it? They are very good. So variable overhead efficiency. So anywhere, it doesn't matter where, anywhere you see the word efficiency, we shall always use Mr. Shah. Always. So remember, we have everything, eh? Yeah, standard hours, they were 1 times the actual number of units produced. Because this is capital SH. Standard hours for actual production times 18,500. Are you able to remember? Sorry. Are you able to remember the actual hours? 17,800. Thank you so much. Do we still remember that standard variable overheads per hour were 30? With 1,000 favorable? 21,000 favorable. Thank you so much. 21,000 favorable. Thank you so much. So now we are through with variable overheads. Now we go to fixed, isn't it? I also love fixed so much because the first fixed variance is what we call fixed overhead expenditure variance. Fixed overhead expenditure variance. So I love the expenditure variance because I normally use that politician or other politicians who are all seasons. Huh? All season politicians, isn't it? Those politicians who are all, do you know them? So before, before Wakoli and Atwoli, yeah, Atwoli. You know, Atwoli is really an all-rounder kind of a politician. He's that type of a politician who will say that this gentleman cannot win elections. Go and cut down all trees, because if you leave even one single tree, there is somebody who's gonna hang themselves, cut them down. The following day, it's announced that this gentleman has taken over. Yeah, he has not lost. And then, of course, now the same gentleman goes and says, this is the president, right? This is the president. And he has been able to survive all through. So anytime they talk about expenditure variance, fixed overheads, always think about before minus Afoli or Atoli, whatever. He's also a confused guy, right? So it is budgeted fixed overheads minus actual fixed overheads. Budgeted fixed overheads minus actual fixed overheads. And if you love them, please, those guys are very nice. I'm only using these for purposes of teaching. Otherwise, I don't do politics totally. I don't even have a voting card. Don't even have a voting card. In terms of voting, I'm not even a Kenyan. In terms of voting only. Yeah, yeah. Because I'm one of those characters who believes that democracy is not the best form of governance. Very costly. Waste a lot of time. Like now from next year, we'll not be able to teach the way we are teaching. So many bad things because of democracy. What if we went the UK way or Dubai way, where we have a monarchy, have a queen and what here, a king, and then we have a soft system going on. Even if your family will not be the royal family, so be it. Yeah, all the children are uko na king, uko na queen, uko na queen. All right. So do we have budgeted fixed overheads? How much? 1 million. Do we have actual fixed overheads? How much? 1040, Thank you so much. 1040,000. So then this one here will end up giving me 40,000 what year? Adverse. 40,000 adverse. 40,000 adverse. Yeah, before minus Atoli. Just like that, yeah. Life does not like complex things, No. Now, after that, ladies and gentlemen, we go to our last variance, known as fixed overhead what here? Volume variance. Fixed overhead volume variance. Fixed overhead volume variance. So do we remember the difference between two volumes? Difference between two volumes. So we have here budgeted volume minus actual volume, and then multiplied by standard fixed overheads per what here, somebody? Per unit. Could you kindly give me the standard fixed overheads? Like now, all that noise you are hearing outside here is just because of democracy. Because, if you chase those people from there, who is going to vote for you? A capital city of the stature of Nairobi should not be having so many people outside there. We should be able to build like Dubai, build for them market areas. And then we force every other person to go and buy from them. But now we have a confused town. Have you ever tried walking in town in the evening? It's a confused town. It's a confused town. So can you kindly give me this standard fixed overheads per unit? Remember, we know that we have fixed overheads budgeted of 1 million. Divided by how many units are we budgeting per month? 20,000. So then this is 50. 50, this one. And then you come now here. So budgeted volume. What do we have here for budgeted volume? Boy, I'm alone, but I will overcome. I'm alone. 20,000. So this is 20,000 minus actual volume of how much? 18,500. And then we put standard fixed overheads per unit outside, right? Which is 50. Yeah, problem? Okay. Remember the standard fixed overheads, whenever they're not given per unit, you use budgetary figures. Budgeted fixed overheads over budgeted output. $75,000. Adverse or favorable? Adverse, right? Thank you very much for saying adverse. Thank you very much. Thank you very much. Thank you very much. You are saying adverse, right? Adverse. Maybe the noise is too much from outside. Are you saying, be very serious, are you saying adverse or favorable? Huh? Ladies and gentlemen, favorable or adverse? It's adverse. Yeah, it's adverse. I thought you were saying adverse all along. It's adverse, isn't it? It's adverse. It's adverse. It's adverse. Because you can imagine, we had planned to produce 20,000 or even sell 20,000, but we sell less. As a businessman, I cannot be happy. And again, if you remember, if I'm the one who taught you this, I told you we have what we call exceptional variances. There are three. The ones we interpret the opposite way, we call them exceptional variances. There are three. Please write them down. Exceptional variances include, exceptional variances include, exceptional variances include, number one, fixed overhead volume variance. Fixed overhead volume variance. Fixed overhead volume variance. Number two, fixed overhead capacity variance. Fixed overhead capacity variance. Number three, all sales variances. So I've written all of them down. There are three exceptional variances. We have a fixed overhead volume, fixed overhead capacity, and then number three, all sales variances. Yes. Thank you very much. In order, very good question. What is the difference between fixed overhead volume and a fixed overhead capacity variance? Later on, I'll be able to teach you that fixed overhead volume variance has got two components. We have what we call fixed overhead capacity and the fixed overhead efficiency. So fixed overhead capacity is a component of volume, but this will come out later. Now, when we say there are exceptional variances, does it mean that they are very difficult to compute? No. It means that all positive variances are favorable, except this one. All positive variances are favorable. So like now, this one here, you got a positive variance of how much here, somebody? 75,000, isn't it? But because it's positive and it happens to fall among exceptional, I will take it as what here, somebody? Adverse. It's positive, but among the exceptional variances. So now, are we in agreement that it's supposed to be adverse? Let's first of all agree. I never knew that you guys were speaking about favorable. I thought for sure that you were team adverse. Then now, given that they only wanted us to do a cost statement reconciliations, mention there a reconciliation statement. Mention there reconciliation statement. So the online guys, are they able still to hear me, or are they getting sound breaks? The online guys, are they able to hear me? Thank you very much. I'm trying to shout as well. Clear, thank you very much. So we have here original total cost of how much? What was the original total cost? You guys had gotten the figure, 7.8 million. Then in between, we have material price variance, material usage variance, labor rate variance, labor efficiency variance, variable overhead, expenditure variance, variable overhead, yeah, efficiency variance. We have fixed overhead expenditure, then fixed overhead volume. And then we have here the actual total cost. So the actual total cost, you guys had given this to me. The actual total cost, you 73, 73, 53, 900. Thank you so much. So then this is what we shall be reconciling. Eh? So please give me this. Favorable. Thank you. $1,054,000. Adverse, right? Adverse, eh? Favorable. 40,000. Finished, isn't it? So then now do your abracadabra from this one. Do whatever you want to do inside here and tell me whether you are able to get your actual being that. Do whatever you want to do there for us to see whether the first one, LEV 49. Thank you so much. But favorable, right? Put 9,000 favorable. So the one who is able to reconcile like this afternoon, I give them 1,000 shillings cash. If they're able to reconcile, get this, I give you just 1,000 shillings right now, right here. I give you 1,000 right now, right here. And please, if yours is not able to reconcile, tell me, Mwalimu, I'm not able to reconcile. If you are not reconciling, you shall never ever cheat. Like Magdalene is saying, Mwalimu, the correct answer is supposed to be 15, 26, 100. Is there somebody's figure is able to agree? And then I ask you a question. Is there somebody who is able to agree to this one? And if you're not able to agree, please give us your answer. Magdalene has gone to read the one that we did. 73, 53, 900. Dennis, give us the secret. What did you do for you to get that correct answer? Because I'm so sure these guys are not getting that answer. Are you getting this? You're getting 7661, eh? Online ninjas, is there somebody who's getting 76 something? So somebody has told you to add favorable and then you subtract adverses, eh? Oh, that's what they did, eh? They added favorable and subtracted the adverses. So remember, we are not reconciling. Fixed overhead volume is favorable. Somebody is saying that fixed overhead volume is, I thought we explained this is adverse. Remember, in terms of costs, a favorable variance reduces the cost. You know, in terms of profitability, a favorable variance, if it was profit, I would have added favorable. But when I'm doing cost reconciliation, favorable, I subtract. Adverse, it's increasing, I add. They haven't gotten this. They haven't gotten this. If it's cost reconciliation, see an adverse increases cost. They haven't understood this yet, but we shall overcome. Adverse increases. Add adverses, and then you less what you pay favorable. Can someone now try that and tell me whether or not it makes sense? Kanyua, thank you very much for getting 76, 61, 100. That's very good, but you did the opposite thing. You did it wrong. Now we are saying that because we are reconciling costs, adverses will be added and the favorables will be subtracted. And if we do that, then we shall be able to see a reconciliation. We shall be able to see a reconciliation. Is it coming to this? They're saying there is a difference. Why a difference? Then I'll be able to give you a shortcut. Don't worry. But first of all, just repeat. Say 7.8 minus 113,500 plus 100 plus 53,400 minus 49,000 plus 54,000 minus 21,000 plus 40,000 plus 75,000. Is there somebody who is able to reconcile? Is there somebody who is able to get this figure? No, eh? Huh? What are you getting? You are getting 70? Is there a figure here that is wrong? Which one? This one here. Or the total is wrong? Remember you got here 7 points? The very original, not flexed. Not flexed. 7.8. And the actual is like that. It doesn't have an error, right? Huh? No, forcing it, of course, even what I wanted to tell you in an exam, you don't have to do this one, but I'm wondering why is it not coming? Because in an exam, we would have just written this all the way to the, without even adding up. Then you say it's because it's a reconciliation, but I'm wondering why is it not picking up? Why are we not getting this? So they're getting 79, 79, 38, 900. Why is it misbehaving? Why is it misbehaving? So somebody is saying it is the opposite, no problem, that we add the favorables and we subtract the adverses. Will that come? Labor efficiency variance, I'm told is 53,400. Labor efficiency variance. Please check. Iko sawa, eh? 3,400. Where are we getting it wrong? Then what we do, at least you guys have gotten very good exposure. Let's try to look for that error. There must be a small error, because if it's cost-wise, we shall always add adverses and then we subtract what here somebody favorables. So thank you so much. It's been a pleasure hosting you. Is the variable overhead efficiency 21 or 12? Variable overhead efficiency variance. Is it 21 or 12? 21, eh? Not a problem. We shall be able to get to where that error is, eh? Don't worry. When we come in our Thursday's class, we shall be able to get where that error is. But I'm so sure you've learned quite a lot. Thank you so much, and bye-bye. Bye.